As we continue to move along, we are now entering into the territory of support, resistance, and trend lines, another critical area of technical analysis, one of the big pillars of support, as I would like to call it. We've already gone through a couple of the pillars, the first being candlesticks, the next being talking about trends and how we want to go with the river, with the current, all that. Now we come upon support, resistance, and trend lines. And this is pretty much what our robot vision is always looking for. Support, resistance, and trend lines. I know support and resistance means nothing to you at this point, but our robot eyes this is what we are essentially always scanning for and always monitoring. How are supports, how are resistances, how are trend lines acting, where are supports, where are resistances, where are the trend lines, all that sort of stuff. And it's a very key facet in terms of keeping emotions out of check, and quite frankly, taking advantage of situations when others are panicking or when others are getting too greedy. We can sit there, relaxed, emotionless, and say, all right, we're going to do this because support or resistance or the trend line is acting this way or has acted like that in the past. All sorts of things going on, but this is a very critical component now in our robot surgery. Depending on how new you are, maybe you've heard the two stereotypical, animals that are referred to kind of two sides of the equation. But at the end of the day, it's actually a very accurate kind of picture of things, because really that's what controls everything. As complicated as the stock market can be, and yes, it can be complicated in terms of all the functioning, what makes it go up, just all the different components of it. There are some very complicated things, that are a part of it. Derivatives, just one little example there. But yes, very, very complicated. But when you boil everything down, it does really just break down to these two animals. And I want to introduce you to these two characters that I've created to explain the stock market. And some people, they're smart enough to handle this. They like this complicated area of the market. For me, my strength, my intelligence level zone, right down here. This is where I want to hang out, at the 1 + 1 = 2 zone. I don't want a complicated, view of things. I don't want to try to compete against people that enjoy all this stuff. I want to compete against people that are all about 1 + 1 = 2. Because remember, trading is a competition. You are competing against other people. Every transaction, somebody is right and somebody is wrong. Somebody thinks, hey, I want to buy shares here because I think the price is going to go up. But at the same time, somebody else is selling those shares saying, I don't think this price is going to go up anymore. So every single transaction, somebody's right, somebody's wrong. But in that competition, I want to be competing against these people down here rather than, the people that are all about this sort of stuff. So with that, I'm going to boil this all down to two simple forces, two characters, but at the end of the day, that's what it is. And that is wanter the bull and giver the bear. That is it. Everything revolves around them. So with that being established now, let's go and learn more about these two characters, forces, whatever you want to call them. Wanter the bull. So whenever you see WTB, that is who I am referring to. But wanter the bull is a force, is a character that simply wants shares. From a psychological emotion standpoint, they are greedy and selfish. They have that gimme, gimme, gimme type attitude. They're kind of a brat, a little brat running around, gimme, gimme, gimme. It's all about them. They are just very greedy and selfish. For you economic folk out there, even if you've just taken a very basic economics 101 or 100 class, that economics, one of the first things you learn about is just demand versus supply. So in terms of that, wanter the bull is on the demand side of that equation. They have a demand for shares. They want shares. Gimme, gimme, gimme. Now, in terms of stock trader lingo, this is where what we call a technical support. A support is just an area on the chart where wanter the bull has shown up before. The more times wanter the bull has shown up at a particular area, the more confidence you can have in that price area. So, well, let me just go, and then I'll start drawing some pretty pictures. At the end of the day, to kind of just hit you right between the eyes with it, a support is simply an area where the price has stopped from going down in the past. Remember, why? Think about it. Why does the price go down? Because people are selling. Yes, true. People are selling. However, why are they selling? Because nobody's really buying. Nobody wants any shares. It's going down, down, down. Nobody wants any shares with any sort of, in any sort of large amounts. So, price is going down, 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 down. And then all of a sudden, eventually it's going to stop and start to head back up. So why did it start to head back up right there? At that point, what made that the price start to bounce back up? I don't know. There's no, for some reason, well, I do know, but as far as who it was it a hedge fund? Was it, an investment bank? Was it, just a bunch of individuals? Who knows? Who cares? But that tells us that nobody wanted. And then all of a sudden, hey, Wanter the Bull showed up. People got greedy and selfish. People had demand for shares, and it went up again. So to continue on in our story, it goes up, and then maybe it starts to head back down again. And then right there starts to head back up again. That's weird. And maybe we're thinking, oh, well, this is all theory right now. Yeah, it is theory, but there are plenty of examples out there where, isn't that weird how people wanted shares again at this area right here? So at this point in time, this is something that, you could draw a line like this and say, this is a level of support. Meaning, remember, what are some of the cores of technical analysis? Learning from past history. So if we look back in the past history and say, hey, look at that. At this point, and then this point, people have wanted shares. Wanter the Bull has shown up and wanted shares. Is it logical? Is it rational to think that, if the price does come back down here, this may be a good area to try to pick up some shares? Yes, that is very rational. Is it guaranteed? No. But is it totally random, totally throwing darts at a board with a blindfold on? Absolutely not. You're making a very valid, very good robotic vision type assumption there. Just because looking back through price history and the history of the chart, people have wanted shares right here. People have gotten greedy and selfish. This is where the little brats showed up. Gimme, gimme, gimme on 2 occasions. So what happens if those same brats, gimme, gimme, show up again? Maybe I should join them and then try to play some sort of bounce upwards. So a very simplistic way, but not really simplistic. That's what it is. I mean, supports are areas where the price has stopped going down. And because it stopped going down, you assume, all right, well, clearly people wanted shares at that area. There was a demand for shares. And that's what we're looking for, and that's what a technical support level is. So the more of those little gimme, gimme, gimme points that you see, the more that Wanter the Bull has shown up at a particular price area, the more faith, more confidence you can have in that particular price area. Now on the flip side of the coin, we have Giver the Bear. And Giver the Bear is a force that simply gives shares. Psychological emotion here is fear and confidence. That can be a little maybe a little confusing, but we should all be fearful at times, but we should all be confident in our fear. What do I mean by that? Well, sometimes you just have to say, you know what, I think this is as high as the price is going to go, so I need to sell here because I'm fearful that if I don't sell here, then I'm not going to maximize the trade. So there's nothing wrong with being fear. Now, if you're panicking and selling where you shouldn't be, that's totally different. But fear and confidence to be fearful is a good thing if you have a plan and if you're making rational and logical decisions, and that's what your chart vision is going to allow you to do. But regardless, when people are giving up their shares, they are fearful, and many of the times they're confident in that. Not all the time, but so I should note that the main driving force here is definitely fear, but a lot of time people are very confident in that fear to give shares away. Now, in terms of economic lingo, this is the supply of shares. There is supply. Hey, do you want shares? We got shares to give away. Here we go. Give them away. Give them away. Here's shares. In stock trader lingo, this is a technical resistance. Resistances are just areas on the chart where Giver the Bear has shown up before. This should sound familiar. Now we're just flipping things around. The more times Giver the Bear has shown up at a particular area, the more confidence you can have in that particular price area as resistance. So it hit you between the eyes. Resistance are areas where the price has stopped from going up in the past. So think about this. Why do stocks go up? because nobody wants to give them away, right? No, I'm not going to sell. No, I'm not going to sell. I'm not going to give these things away. I don't want to give any shares away. And then the price heads back down. All right. So what happens up here? For whatever reason, people thought, you know what? That's as high as it's going to go. I'm ready. Hey, who wants shares? I'm going to give them away. I'm going to give them away. And they gave them away, and now the price starts going back down. So continues on back down. Heads back up. You know, nope, nobody's giving them away. Nobody's giving them away. Nobody's giving them away. And then right there. But here's a little quick quiz question. What would this point be right here? If you said, wait, that would be a support, good job. Why would that be a support? Because think about it. Now people are giving them away, giving them away, giving them away, giving them away, giving them away. Nobody really wants them. Nobody really wants them. Hey, yeah, I'll take some. Gimme, gimme, gimme. And then the price starts to head back up. So do you see how that worked? Resistance and then support all of a sudden showed back up. But back to talking about resistance. So the price heads back up here and then there again. Hey, those giver the bear showed back up. People were willing to give away shares at this area, and then it heads back down. So if you bought shares somewhere below and it got back up here, would it be logical to say, you know what, I should probably lock in some profits up here? Yes, absolutely. Should you be confident in that? Should you be fearful first off? Yes, you should. Why should you be fearful? Because technical analysis, one of the cores, learn from previous history. What has happened up at this point twice before? People have sold and the price has gone back down. So seeing that, you should be fearful, like, okay, you know, it seems like, you know, the price is probably going to get knocked back down. But you should also be confident because you notice what's happened here. So yeah, you can sell up here. Now, is it guaranteed? No. But is it very rational, very logical? Absolutely. And that's from simply looking back at the history of the chart and taking note at where Giver the Bear has been hanging out. And clearly, Giver the Bear, for whatever reason, we're never going to know the reason why they're hanging out, where they hang out, but Giver the Bear has been hanging out there, and then a second time right there, so it's logical that, you know, a potential third time, you know, maybe sitting right up there. And I totally, you know, acknowledge, well, right now I'm just drawing pictures, and this is my little perfect world, but we're going to get to plenty of examples that show support and resistance in action. And then when you go back and pull up your own examples just through random ticker symbols and scroll back through charts, you know, you're going to see things on charts where, wow, look at those candlesticks. Wow, those upper shadows. Why do those upper shadows? They always stop right around that same area. And it's really gonna open your eyes. It's pretty cool actually how it all works out. So when we combine these two forces, these two characters, we get the never-ending war. And it's just a psychological war of emotion. So going forward, if this analogy works for you, fantastic. But you know, this is how I always looked at it. You know, when I got started. And imagine the chart as a battlefield map. And the map contains two key components: a past history of battles that have occurred, and then kind of like a futuristic map where it's potential areas where battles may occur. So the two things here, where battles have occurred, and then the futuristic map where battles may occur. And what emotions are involved in this war? Well, hopefully you've kind of put those pieces together, but ding, 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 we have want versus give. That's it. Want versus give. Demand versus supply. However you want to look at it. Fear versus greed. It's all, whatever clicks in your mind, look at it like that, but I look at it as it's simply just want versus give. Are people wanting shares or are people giving away shares? So think about it. Every single transaction in the market produces a battle of opinions. I have already kind of touched on this, but whenever you are making you know, a sell order or a buy order, that in and of itself is a little micro battle. It's a little micro transaction. You are saying, so if you own shares, you are saying, all right, I'm going to sell right now because I think that. So if you're selling, what are you doing? You want to give your shares, give them away to whoever will take them. Why are you giving them away? Because you are fearful that, you know what, I don't think the price is, you know, going to go in my direction anymore, so I'm willing to give them away. But somebody else wants them because they're going to buy them from you. So who exactly is right? Again, everybody's right or wrong. Everything is a little miniature battle, and it all boils down to that ding, 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 want versus give. And that's what happens over and over and over again in the market. But we're looking for more of those overall areas. Like I said, when you and I do it, that's just a little micro, battlefield or battle. But we want to see kind of the overall battle and where some of these key areas of want and give are. To go along and stay on the path of, everything's, we have a battlefield map. Both Wanter the bull and Giver the bear build fortresses. For me, at least when I was a kid, I liked to build fortresses, but that's what they do. Wanter the bull fortress, where there is want, that creates areas of support, wherever his fortresses are, or hers, however you want to look at it. Giver the bear fortresses is where there is give, and that creates areas of resistance. So there's forts all over a stock chart. They're all over the place. Some forts are owned by Wanter the bull. Some forts are owned by Giver the bear. When the price approaches one of these fortresses, you cue the boxing announcer and, say it in your best boxing, announcer voice impression. But it goes to one of these things where it's, standing in the right corner and challenging and then, so if the price is approaching a level of resistance, it would be, and the bulls are approaching the bears at the bears fortress, something like that. And I understand that's there's a reason I'm not a boxing announcer, and you just witnessed why that is. But that's essentially what's going on. When the price is starting to approach an area where that, okay, that has been an area of support in the past, it's pretty much like a boxing match is coming up. We have want versus give. Who's going to win out here? Now let's talk about some just very fundamental, very core concept-ish lingo that you're going to hear as a trader. Maybe you've heard it and you're like, I'm not real quite sure what that means. Or maybe you've heard it and you understand the general philosophy of what it means, but you've never really thought about, what exactly does it mean from an emotional standpoint, from a psychological standpoint, from an economic standpoint. So that's what I want to talk about here in this slide. And this is one where I'm not going to say it's worth printing out if you haven't, but you might want to kind of print this one out. But so let's talk about some battle outcomes. And this is we are gonna look at things from Wanter the bull scenarios and outcomes. So when Wanter the bull is in attack mode, so they hop on their horses and they are charging, the price is moving upwards and approaching a fortress of Giver the bear. So that's what attack mode would be. Remember, I already drew that out. Attack, 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 attack. The price is moving upwards, and somewhere on the chart, there is an area where in the previous history, this has shown to have knocked down the price. The price can't get through this level, so that implies that, okay, Giver the bear has some fortresses up here. This is a level of technical resistance. So as the price is moving upwards and approaching that level of resistance, there's two possible outcomes. So if give overwhelms want, so the supply overwhelms the demand, in trading lingo, that's just going to be a price rejection. The price is going to come up here and get rejected. It's going to get knocked back down. Think about that. If there's more give up here than there is want for shares, then that's just going to knock back down the price. There's not enough to sustain this upwards move because there's more give than there is want for shares. Now, second scenario. So charge, 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 here we come. Now, if want overwhelms give, then trading lingo is we have a price breakout. We have a technical breakout, meaning at this point, if there's more people that want shares than there are that are willing to give shares, then there's only one thing that the price can do. Basic economics. If demand is more than supply, boom, right here we have a technical breakout. So when you hear people saying, hey, it's a breakout, or, such and such stock just broke out, what they're just saying is, hey, all of a sudden there's more want than there used to be in terms of give. So things have kind of flipped around. That's what a technical breakout is when the desire for shares overwhelms the desire to give shares away. Now, let's talk about defense mode. So we have an area on the chart here where, the price is shown that it's bounced from this area multiple times. Well, I just gave away one of the terms. Sorry about that. But where the price has stopped from going down multiple times. So we have that. Now, the price is approaching. and probably one of the best scenes in all of movies as far as I'm concerned. If you've ever seen Braveheart, if you haven't, I'm giving you homework. Go watch Braveheart, probably my favorite movie of all time. But if you've seen it, you remember this scene for sure. But this is how I picture when the price is approaching a level of support, approaching Wanter the Bull's fortress. I just picture it like this. They're sitting there, steady, hold, and then the price reaches this area of support, and there's going to be two outcomes that's going to happen. If give overwhelms want, then the trading lingo is it's a price breakdown, meaning the price is going to come down here and then just keep on going. A price breakdown. It has broken through, this fortress, this wall, and it is now through because the desire to give shares has overwhelmed the desire to want shares. So to maybe numbers work better, just real simple. Let's say that at this level, there are 10 people that want shares. However, if there's 14 people that want to give them away, what's got to happen? Well, this 10 is going to get overwhelmed, and then it's just going to need to continue on downwards because the give has overwhelmed the want for shares. Now, second scenario, price is coming down. Now, at this point, if want overwhelms give, then in trading lingo, we have a bounce. That's what a bounce is. Maybe you've heard that before. I already used the term. I let it slip out. But that's simply what a bounce means, is that the price has been falling, and then it approaches an area where all of a sudden people are, gimme. Yeah, I want those shares. Gimme. There is a demand for those shares. And in this situation, if there are, let's just say, again, 10 people that want shares, but at that level, there's only 6 people that want to give them away, then what's going to happen? The price is going to have to bounce back up, and this is going to remain a level of support. So that's all it is there's two outcomes for, Wanter the bear, or Wanter, the bull. When they are in attack mode, it's just, can the want overwhelm the give? If it can, you get the breakout. When Wanter the bull is in defense mode, when the price is approaching it, it's one of those things where steady, hold, and it's got to be something where if the support is going to hold and produce a bounce, then you want the want to overwhelm the give. You want the demand to overwhelm the supply of shares that are available. You want the greediness to overwhelm the fearfulness of selling. So that's all that it is, and it happens over and over again. And like I said, I know this is all theoretical right now with just pictures, but we're going to have plenty of examples that actually show, how this works out. So hopefully you're on board saying, wow, this stuff is pretty cool, but while I agree it's cool, how do we find them? So let's talk about that. Within the world of technical charts, there are things that create support and resistance. Now, as I've said, we're never going to know what exactly is the force. Is that a mutual fund? Is that an investment bank? Is that insiders buying shares? We're never going to know that. But we are going to know, okay, there's some sort of force sitting there. Wanter the bull is sitting at a certain area, or Giver the bear has built a fortress at another area. As far as who is behind it, we don't know. We just have to use the broad overall character. But the things that create levels of support and resistance can be previous highs, so previous upper shadows of candlesticks, previous lows, in other words, previous areas of lower shadows of those candlesticks. So just let me draw up a quick candlestick here. So if we have a candlestick like this, and now the price is, over here, right down here could be considered an area of support. Why is that the case? Well, let's think about what is candlestick psychology. Remember, price going down. So give, and then right there it stopped, up. I want. So right here, want all of a sudden showed back up. So that could be an area of support. So if you want to look at it, in all actuality, every single candlestick has two things, a support and a resistance. The top of that upper shadow is going to be resistance because that's where the want finally kind of ran out on the day. And then it's also got that low of the lower candlestick, or of the lower shadow, and that shows where the give finally stopped for the day, and then the want took back over. So you can look at every single candlestick is having both a support and resistance as a part of it. Moving averages, as you know, more to come on that later. Those can be areas where you find support and resistance. And then trend lines, and these are just lines that are used to map out trends within a period of time. So hopefully that makes sense. It actually took me a while before it finally dawned on me. Trend lines. Oh yeah, they are just simply lines that show a trend, and that's exactly what they are. These are used to draw chart patterns, and we'll have plenty of that later on. And remember the connect the dots game as a kid? Sometimes the dots usually had numbers by them. It is the same exact game here. You just connect previous highs and lows, or just general areas. When you're not sure, where exactly should I be drawing this line, because that kind of sticks a little bit lower than that, what I like to call is you just split the difference. Try to draw the line right through the middle of where the two kind of conflicting points are, because what I've learned over the history of teaching and education and all that is trend lines can stress people out, because like, well, it's not quite I guess, well, what about that point? Should I draw it at this angle or that? Remember, they're just lines that are showing the overall trend, so you don't need to sit there and get gray hair or lose hair or anything like that. Just split the difference on them and go with that, but don't spend too much time worrying about the details. And I'll show what I mean by that as we go through the course more. But just remember, split the difference. Don't get hung up. Don't lose sleep over, is my trend line right, or should be a little bit different? Don't worry about that sort of stuff. Now this is very important, and this is one of the signs when somebody doesn't quite get it. If you hang out on message boards or social media or chat rooms, or really anything, even just reading blog articles, a very telling sign is people that say, oh, this exact level, that's going to be this exact precise level. Well, that's not how supports and resistances act. It's more of a web, and supports and resistances are definitely not exact or precise. So what I want you to do is imagine that there is an invisible web surrounding the price, and whatever the price is, that's where you determine it to be support or resistance. So that's the location, that's kind of the zone of the web, or the kind of range. So let's just put a number to this example. So let's say, hey, it looks to me like 45.83 is support. Now, if you don't quite get it, people are going to say, yes, 45.83 is the exact support. So if it hits, 45.82, broken support, it's a breakdown. Well, not really. I mean, think about it. $45.83, that's a pretty, expensive stock. So in this case, but, you going forward, I myself, I picture the web. You're going to start to picture the web. We're going to look at it and say, it's probably more like 45.75 to 45.90. Now, there's definitely no exact science onto the range of it. Sometimes other components of the chart will help you determine the range and make it a little bit easier. However, there's no exact science in terms of, what this range exactly is. But, the one thing is, the higher the price becomes, the larger the web becomes. So if you're talking about a stock that trades for, $1.50, then yeah, you're not going to want to say that the range is 10 cents in either direction. However, if the stock is trading for $150, then yeah, 10 cents is really probably too small. It would be a bigger range than that. So the size of the web more specifically corresponds with the price of the shares that are trading. So a bit more imagery here, going back to castles or our fortresses. They just don't have one wall. They have tiers of walls that enemies must continue break and break and break in order till they finally claim everything. So just look at the web as multiple tiers of walls within a fortress. So when you look at it, attackers here. Okay, first we got to get across the moat. Okay, then we got to battle across this wall. Okay, then we got to battle across this wall. Then we got to try to climb up here and get, multiple areas in the web, multiple sequences to finally breaking through and considering it a full breakout. So again, going back to here, the people that really just don't understand, they would say, all right, if this is support and the price hits 45.82, they would say that means the whole fortress is overtaken. Well, no, not really. Maybe they've gotten across the moat, but there's going to be some other areas that would need to be, broken in and such before you could consider this a complete, breakdown and, capturing of this entire fortress. So just remember the web effect. What I'm getting at here, in very simplistic terms, it just goes right up to to this point right here, support resistances are not exact or precise. They have a range to them, and the best way that, at least for my childish mind, is I like to look at it as like a spider web or a multiple wall, fortress. Finally, another one of these slides where it's probably worth printing out, but very, very crucial concepts in the world of not only technical analysis, but when it comes to support and resistances. Supports are areas where stop loss orders should be placed below. You never want to place a stop loss order right at a support, because if right at the support is historically where people want shares, why in the world would you be looking to sell shares at that point? That makes no sense, but people do it all the time. They say, okay, a support is at 1504, therefore I'm going to put my stop loss at 1504. Wait a second. Think about the psychology. Think about the emotional aspect. 1504 is the support, therefore that has been an area where people want shares. So why are you looking to give shares at an area where people historically want them? That makes zero sense. But what makes more sense is to put it slightly below the area of support. So if you put it at 1497, okay, that makes more sense. Because remember, supports are not exact, so you want to give a little what I call wiggle room. So you give it some wiggle room, and then if it hits 1497, okay, it becomes a logical assumption that, all right, people no longer want shares, they're looking to give them away, so I'm just going to join that party and give them away at 1497. But again, if a support is at 1504 and you're putting it at 1504 or 1503 or something like that, think about what you're doing. Historically speaking, because that's how you know it's a level of support, so historically speaking, you know that people want them at that area. So why in the world are you going to be giving them away at that area? Give them away slightly below that, because that would imply that the psychology of things has changed from want, give me, to here, give. So you can then give them away when everybody else is giving, but don't give them away right when everybody else may be wanting shares. I mean, it makes no sense, but people do it all the time. So stop loss orders should be placed below areas of support. Now, resistances, these are areas where profit lock orders should be placed in front. I like to call this kind of cutting in front of line. And so let's just say resistance is at 2171. Cut in front of line, because remember, you're not the only person that uses charts. I'm not the only person that uses charts. A lot of people are going to be staring at that 2171 area. But if you just put the sell order at 2168 slightly in front, that's going to kind of, so it's like, you're waiting in line for movie tickets. That just allows you to all of a sudden come to the front of your line and get your ticket first. Sure, you're not getting as much, but you know what? Sometimes it's worth it. Do you have to do it? No. If you want to put it at 2171, that's fine too. So I guess ideally, this should really be, now that I stop and think about it, ideally, personal preference. Like I said, for me, I always cut in front of line. I try to put it a little bit ahead, but I guess, that's not an exact way. Here, I'm standing very strong. You don't put stop losses at a level of support. You put it slightly below. But here, yeah, I'll bend a little bit and say, if you want to put it right at the resistance, that's fine. I just prefer to cut in front of line. And then the second massively important concept, because you see it over and over again, is that when a resistance is broken and closed above, think about what that means. That means the bulls have overtaken the bear's fortress. They move into the bear's fortress. And when the bulls move into the bear's fortress, when Wanter, the bull, moves into Giver, the bear's fortress, they raise the flag, and now they own the fort, right? So they move in. Therefore, in charting lingo, in technical trader lingo, resistances become support levels. And when support levels are broken, they become resistance levels. And it's just, a very quick transition into that. Bearish levels become bullish levels. So again, when resistance is broken, it becomes support, because that just means that Wanter the bull has moved into Giver the bear's fortress. Or on the flip side, when Giver the bear moves into Wanter the bull's fortress because they have overtaken it, that's where support levels become resistance levels. And we're going to see plenty of that through the course. So you'll see that over and over again. But right here, very, very important concept. Resistance becomes support levels when broken. Support becomes resistance levels when broken. So that wraps up this. We're going to go back and now take a look at our case studies and really start to combine things now, because now we can learn. Remember, a lot of candlesticks has to do with location. Then you probably weren't real sure, well, location as to what? I don't understand this whole location thing. Location next to support or resistance levels. So I'll just leave you with this hammer candle, or a candle. Let me just draw it because I proclaim not a lot of memorizing. So a candle like this. So you have a small little upper shadow and then this, a long lower shadow. So you know this already. Okay, that means that the price is way down here and then the buyers step back up in force. But what happens if I told you that also down here, what happens if I told you, hey, and that level right there was a support level? Really? So you're telling me that the price came down here and was right around this zone of a support level where people want, and then it bounced from there? Okay, so now we're getting a bullish possible reversal candle that's happened at the location of a support level. Oh, a couple more pieces have come together, and that's where we're going with all this. Candlesticks that happen near these areas, that just starts to increase the probabilities more and more into our favor. So next video, we're going to take a look at those case studies and see what we can put together in regards to that.